I'm your host, Tom Shaughnessy, and welcome back to Chain Reaction, a research-driven podcast that's a part of Delphi Digital. If you're not on Delphi's research portal, you're missing out on the critical analysis read by the top minds in the crypto space, so be sure to check it out. One quick housekeeping item. Nothing said on this podcast is a solicitation to buy or sell any security or token or to make any financial decisions. I may personally hold tokens mentioned on the podcast, and you can view our show notes below for our complete disclosures. With that out of the way, I wanted to give a quick shout out to our wonderful sponsor, eToro. The best way to be smart about trading crypto is to use the smartest trading platform. eToro is one of the largest trading platforms in the world, with over $1 trillion in trading volume on the platform per year. U.S. customers can trade the most popular crypto assets with extraordinarily low fees. And if you're not ready to trade yet, you can practice on the platform with their virtual trading feature. Best of all, you can connect with 11 million other eToro traders around the world to discuss trading, charts, and all things crypto. You can create an account at b.tc/eToro reaction or click the link below in your show notes. Just scroll down on your phone, click the eToro link, and it'll bring you right to their website. Hey guys, I also wanted to tell you about how tokenized real estate is here. Realty is the first platform for tokenizing real estate on Ethereum. Realty fractionalizes real estate into affordable tokens on Ethereum, which means that you no longer have to have a significant net worth to invest directly in real estate properties. Realty properties start at just $63, and properties on Realty are curated by their team of real estate experts. If you are not a U.S. citizen, visit realty.co, that's REALT.co, to sign up now. Browse the marketplace to view properties that are tokenized on Ethereum today. With that, let's jump into the episode. Hey everyone, welcome back to the podcast. Today I'm thrilled to have Kain on from Synthetix, who is the founder of the platform. Kain, how's it going?
Hey, thanks very much for having me. It's good.
Yeah, of course. And for everyone else, I also have my partner Medio on. Medio, how are you?
Good.
So Medio did our deep dive on Synthetix. I'm also thrilled to have read it and research it with MJ. And Kain, it's a pleasure to have you on. Why don't you give people your quick bio for those who don't know you?
Yeah, for sure. So I actually run a payment gateway in Australia, which is kind of how I got into crypto. We started it in 2014. We work with a lot of the local crypto exchanges here in Australia, and we also work with some of the overseas exchanges. So Binance is one of them, et cetera. So that business, as I said, has been running for about 5 years, and it was kind of what led me into the path of stablecoins because bringing funds cross-border for crypto, for arbitrage, and a whole bunch of other reasons was kind of a critical issue that needed to be solved in 2016, 2017, and we were finding that there was a lot of friction around dealing with banks, overseas banks, et cetera. So that's how I got into the space, I guess, and what led me to create the original Haven project, the Haven protocol. But obviously we pivoted away from a stablecoin and now moved to more of a synthetic asset platform.
That's awesome. Yeah, and you can't beat the weather over there, which is hard to beat. But just diving into Synthetix, because there's a lot we have to get through, because it seems complex from the outside, but once it clicks, it really clicks here. What's the elevator pitch on Synthetix, and where is the platform now? Is it on Ethereum? Is it on another platform? Just to update the listeners.
Yeah, so the focus is on Ethereum, and my view, I guess over the last couple of years we've explored a number of different options, but I have a pretty strong view right now that Ethereum is the place to be for a whole bunch of reasons. And we can get into that later around composability and being able to leverage some of the other protocols that exist on the platform. But yeah, the focus is very much on Ethereum right now. And I guess the elevator pitch is that we want to be able to have exposure to a number of different asset classes, commodities, Forex, different types of cryptocurrencies that don't exist on Ethereum, that aren't ERC20 tokens on the Ethereum blockchain. We want to be able to bring all of that activity onto a single platform, and that's kind of the idea behind Synthetix, is to give people price exposure through a synthetic token for almost any different asset that you can imagine, as long as there's a price feed for it.
Yeah, no, absolutely. I think that was one of the things that really attracted me, when I first dived into the project. Obviously, DeFi is a growing sector on Ethereum and will only become more important in the future. Seeing the potential that a protocol like Synthetix can offer, it can have some profound impacts. You can imagine a point in the future where, hypothetically, you're trading the stock market on Ethereum through synthetic tokens issued by the platform. So there are a lot of very interesting use cases. You can go long and go short, and really any type of asset that has a reliable price feed is something that you can make a synthetic asset to track. So I think, just in terms of the potential of the project and what it can offer, I think, it's a clear standout in that front. While we're on the topic of just, talking about different possibilities that Synthetix offers, maybe you could discuss a little bit about upcoming synths that you have in mind, or, where you want to go next. I know, fairly recently you launched your centralized exchange token synthetic index. It'd be great to hear about how the market received that, and your plans for adding to the list of assets moving forward.
Yeah, for sure, and I think you nailed it. The opportunity here is to kind of bring all these different assets onto Ethereum and let people have exposure to it. I think to kind of take a step back from that, what I think a lot of the people in the Ethereum ecosystem sort of see is, once we've solved some of the onboarding challenges and UX challenges, that you just open up these assets and these different types of financial instruments to the entire world. Ethereum being a permissionless platform, as long as you've got an on-ramp in some market, anyone can have exposure to equities, indices, all kinds of different instruments. So I think that's kind of the promise. Obviously there's a lot of things that need to happen to get there, but in my mind, that's where I think, a lot of the value is going to come from. But to sort of speak specifically to, I guess, where the value prop is right now, where we see it kind of emerging, the challenge is that there's a trade-off between, different assets and current demand. So, while we see in, I guess, the longer term significant demand for equities and indices and other, more traditional assets, probably in the short term, given all of the things that, we still need to deal with, scalability, onboarding, UX, so all of the things we need to kind of bring, tens of millions of people onto the Ethereum platform, there isn't a huge amount of demand right now for those assets. And so where we've kind of seen the immediate demand has been more around crypto assets, and trying to thread the needle, I guess, between, assets where we know there's genuine demand, things that are already trading on, BitMEX or OKEx or Binance, et cetera, where, there's a lot of trading activity and we know there's people using it, versus new, highly differentiated assets like, the Synthetix Exchange token index, which is kind of something that you can't get exposure to anywhere else. It's a very unique asset. We launched it about a month ago. I think there's about $50,000 or $100,000 worth of open interest, both long and short, on that token. But again, it's going to take us a while, I think, to bootstrap the platform to get to a point where there's a lot of demand for some of those very unique assets, and there's an education process that has to happen as well.
You make some great points, and while you touched on the concept of bootstrapping adoption, I think that's where the SNX token plays a very interesting role, especially compared to other projects where sometimes the token feels like an afterthought rather than a necessity. Maybe you could talk about how SNX helps bootstrap early adoption and can help grow the platform to a critical mass.
Yeah, so interestingly, I think it didn't always do that, right? It didn't always help to bootstrap. We definitely got it wrong initially. When we launched the token, if you go back to 2016, 2017 and look at some of the narratives and some of the kind of views that were being expressed by people in the space, there was this idea that, fixed token issuance would create scarcity, right? And demand combined with this fixed issuance model would drive adoption. And I think what we've seen is that just isn't true, right? The market has kind of responded and said, well, actually, no, that's not a thing. And so, what we realized in kind of mid to late 2018 is that we needed a mechanism that would allow the protocol to incentivize people to participate. We had almost 70,000 token holders, and maybe 30 of them were actually staking and actively participating in the network, in kind of mid 2018, which was 3 to 6 months after we launched. And we looked at that and we said, okay, we need to change this fixed issuance, and we need to move to monetary policy where people who are actively staking the network will be paid for doing that. And that will allow us to bootstrap. And, it's very similar to, other models that we've seen in the past. I mean, Bitcoin obviously, uses protocol-based incentives for miners to encourage people to download the software and mine, especially in the early days. That was pretty critical to bootstrapping. And that has kind of allowed us to actually, over the last 9 months, really bootstrap the network. And now we have over 80% of the tokens are actively being staked. We've got several thousand individual participants who are actively staking, and we're starting to get to a point where we now have hundreds of traders as opposed to tens of traders. So the flywheel is definitely going, but it wasn't always going, and we needed to kind of take an iterative approach to get there and get the incentive alignment right.
Yeah, no, that's a great point. And just talking about how you use the token to incentivize certain behaviors within the community, I think a great example of this is how you guys got the Uniswap ETH arbitrage pool off the ground and the impact that's had on the platform. Maybe you could just talk about how you targeted, you diverted away some of the SNX issuance to kind of fill these gaps in the near term, and how that Uniswap arbitrage pool plays such an important role in the Synthetix platform functioning.
Yeah, so again, we take a very iterative approach, which I know is sometimes frowned upon. This idea that you need to say what you're going to do 5 years ahead and then never change it. But our view is that reality tends to disabuse you of your assumptions and notions that you start with. And so, one of the things that we realized pretty early on is that we could have this great trading platform where people could take advantage of the kind of infinite liquidity model that we have. But if there was no way for people to deposit and withdraw from that system, to move in and out of that system, then, you just had this kind of island with no bridges to it. And obviously, we're big fans of Uniswap. We think, it's probably one of the best and most permissionless DeFi protocols out there. And so, we saw an opportunity to essentially divert some of those protocol incentives to get people to change their behavior, and rather than staking SNX directly in the network, to take some of the synthetic assets that they'd issued and actually stake them alongside ETH to create this bridge, essentially, and to bridge the protocol to the broader Ethereum ecosystem, with the intent that if you turn up and you have ETH, that you can convert that ETH fairly easily into synthetic assets and then start trading on the synthetic asset platform. And obviously, similarly, and probably more importantly, once you're done trading and you want to take profits or exit the system, that you have a simple and efficient off-ramp as well. And as you say, that's one of the examples, but there's been numerous examples where the community's made a decision to divert some of the protocol incentives to other activities that we want to incentivize.
Absolutely. And I think that, the current model that you have in place right now, it's clearly working based on your recent growth year to date. Just for our listeners that might not be familiar with the SNX issuance policy, from March 2019 through March 2020, I believe it's plus 75%. And then afterwards, the following year, it declines down to 21%. Recently, there was a governance call you guys held that kind of discussed changing the monetary policy of SNX to better suit the platform. And I think this kind of reverts back to your earlier point about having kind of forcing an economic policy or an issuance policy on SNX that might not be ideal for its given situation. So maybe you can talk about how you see the role of SNX evolving over time, and how you're considering, changes to that issuance policy.
Yeah, so again, like I've been in the space for long enough that most of the things that I cared about when I came into the space were Bitcoin. There was some other interesting things like Namecoin and various other things that were going on, but the reality is most of the research that I did initially when I came into the space was around Bitcoin and around payments. I come from a way back in the early 2000s, an online retail and payments background, and inefficiencies in payments was a big thing that drew me to Bitcoin. And looking at the Bitcoin issuance and the monetary policy of Bitcoin and the halvenings, and trying to kind of tap into, I guess, the mechanism that had worked so well, it made sense to take a high inflation rate early on, and then cut it back later. I think probably the big difference with what we initially launched with was that it started off at 75% and it tapered fairly quickly. Bitcoin, the halvenings are spaced out quite a bit wider, and I think that as we've gotten closer to this cliff that was created, people started getting concerned. Probably the most interesting thing about that is that I was personally not that concerned about it. I didn't think that the cliff was going to create a huge issue. I pushed back quite a bit on some of the community members who were sort of agitating for this change, but they continued the conversation, and now we've got to a point where I'm convinced. I think it actually makes sense to do it, and I think the majority of the community is convinced, and it does somewhat speak to the value of kind of rough consensus as opposed to on-chain voting. If we had an on-chain vote, the day that was proposed, I think the combination of the foundation and some of the internal team members would have been able to kill that proposal pretty quickly. It does speak to the advantages, I guess, of not formalizing token voting and allowing the community to kind of iterate towards some kind of Schelling point in an agreement where people say, okay, actually this is a risk and let's change it, and let's discuss how we change it and what the options are, et cetera. So it's been really validating to kind of see that process evolve.
So Kain, I mean, you just kind of walked through the process of how your governance kind of happens and why you guys chose not to go with on-chain governance, one token, one vote. But I mean, more formally, what actually is the formal or informal process for deciding on changes on the network? Is it more of, discussion forum and governance calls and kind of, the key stakeholders kind of decide and push something through? Or I'm just wondering the process going forward, because governance really comes into play as you grow as a network.
Of course, yeah. It's a high risk situation, and no decision is still a decision. So I don't think we have a formalized sort of governance structure. We have a mechanism for protocol changes similar to the EIP process in Ethereum, which is obviously modeled off other earlier processes in open source projects. But we I guess believe that we should allow a conversation to sort of evolve organically to a point where there is some consensus. I'm a believer that two equally informed people can't actually disagree on something, right? There is genuinely a right answer about how to approach something, even if that answer might be somewhat probabilistic. But if you've got a community that's discussing something and you give it time to find, as long as you're not in a rush to try and come to some conclusion, I think that they will eventually converge on the right answer. And if they don't, and in this case we may not, we might get it wrong, you leave the door open for reviewing the data once you've made the change and potentially reverting it or iterating on it. So we're very much I guess trying to keep an open mind in terms of how we let these conversations evolve. And one of the nice things is our community is extremely engaged. So there's a lot of fairly diverse opinions that are floating around at any given time in our Discord, in the chat room, and that kind of helps to, I guess, create an environment where pretty much everyone feels like they can step up and and make a comment or criticism or whatever, and it creates a fairly open dynamic. That said, to your point around, as things get bigger, it definitely gets harder. You've got more voices, more noise. But I think for, the foreseeable future, we're in a pretty good place with the current mechanism we've got.
Absolutely. And, as someone who reads the Discord chat pretty frequently, I would agree that you have a very engaged community, relative to some of the others I've seen. So, congrats on, getting that community buy-in. Quickly, while we're on the topic of, governance and, significant changes to Synthetix moving forward, I know another big issue that was talked about recently was, the addition of, using ETH as collateral in the pool. As we touched on recently, of course, SNX is collateral for the platform currently, and because of that, it does have some nice, it can result in a nice positive feedback loop for bootstrapping adoption, as we mentioned. But moving forward, how do you see the role of collateral maybe evolving for the platform? Do you see SNX having the same role, or do you see it maybe having a lessened role over time as that pool is diversified with something like ETH or hypothetically even DAI?
Yeah, that's a good point. So I think there's two kind of fundamental assumptions that we've made around how the collateral in a system like this should operate, and this comes from the payment network mechanism that I initially proposed back in kind of late 2016, early 2017, which is that if you are pooling collateral from a distributed group of people and paying them rewards for putting that collateral at risk, and you generate sufficient activity in whatever the thing that they're enabling by pooling this collateral, such that people will pay fees for having access to that functionality or that product or service, you can feed back those fees into the collateral, and you can create a system where someone can look at the activity that's happening and the demand for it, and they can project out that demand and the growth of it, and they can come up with at least a somewhat reasonable and rational projection for what the value of that holding that asset will be, factoring in risks, et cetera. And obviously everyone's going to have a different model and different view on it. But it is a fundamentally different kind of valuation methodology than a lot of the crypto assets that we see, which are kind of payment tokens for a network, and it's very dependent on how much demand there is, what the velocity is. It's much harder to kind of model the value of those assets. And that's just fundamentally something that, I believe, and I think it's kind of, it's slowly getting to a point where people are agreeing to that. I know obviously you guys, in your research kind of came to that conclusion as well, or, at least started from that conclusion, but it was validated. So I think more people are coming around to the idea that you can create an asset where you can look at the cash flow from that asset, and you can create these distributed systems where a bunch of different people are providing a service to a bunch of other people, and those people are paying for that service, and you can have a self-sustaining network. That obviously is something that you don't want to break. That we need SNX as collateral to be able to continue to have that sort of preeminent position in the network. The intent behind adding ETH collateral is really about ease of access. There are people that will want to get access to the system without necessarily selling ETH or other crypto assets to get synthetic assets, which they need to be able to kind of avail themselves of the platform. And if we can allow them to essentially stake ETH and get synthetic ETH, as a byproduct of that staking, and participate and use the platform, but without kind of getting the rewards or taking the same level of risk as the SNX stakers, I think you can have a really sort of good hybrid model for collateral where it isn't just one type of collateral, and you don't have the risk of a significant decrease in activity creating a negative feedback loop, because you do have this other collateral asset that's kind of sitting in there. And anything that we do that creates additional demand for synthetic assets and for trading those synthetic assets is a positive for SNX holders. So that that's kind of the rationale behind why we've introduced that. It's about ease of access, but it's also about finding a way to add collateral without diluting the value proposition of SNX, which is the SNX token has to capture the sort of entirety of the economic activity that's happening in this network. As soon as you break that, the model breaks and falls apart.
Yeah. Just to touch on that point further, and that's something that really appealed to me about the token economic design of Synthetix, where the platform literally can't work without that token capturing value and growing in price, because the amount of Synthetix you can mint is limited by that factor. So some really nice economic design there that I think is a standout relative to some other projects. But of course, for all the points you mentioned, there are of course upcoming changes and risks with that as well.
So, Kain, just switching gears a little bit on Medio, that was an awesome line of questioning there, but just switching gears a little bit to some risks and how the platform works. You guys are dependent on reliable data feeds to ensure that the prices on your platform, are accurate and can't be manipulated. And this goes back to the discussion on price oracles. How do you guys handle price oracles, and are there going to be any significant changes in the future?
Yeah, so, when we started the platform, there wasn't an option but to kind of roll your own oracle, which is, as dangerous as rolling your own crypto, I think, if not more potentially. So, we did that knowing full well that it was a bad idea, but that, the alternative was just waiting until there was some viable, decentralized oracle solution or distributed oracle solution. We're now lucky enough, I think, for those people who don't know, we did have an incident back in July where there was an oracle outage that was exploited, and you can read about that if you want to kind of follow up. But the interesting thing about that process was one of the kind of byproducts of that is we had at least 10 different projects reach out to us and say, hey, we've got an oracle, we can help you. And that was really helpful for us, I think, to kind of bring in a lot of R&D very quickly and be able to talk to a lot of different teams with different approaches to this problem. And I think ultimately for DeFi to work, we need a range of solutions. There's obviously at the very kind of bleeding edge, things like Augur, which are slower but heavily decentralized and can act as a backstop. And then I think there's, maybe more centralized, but, closer to, say, distributed price feeds that are faster. And this is one of the challenges. When you're building a trading platform, you can't have a 2, 4, 6, 8 week resolution process, right? The process needs to resolve within seconds. And, you have to trade off some decentralization for that, certainly now. And so I think that, in the short term, we made a decision to work with the Chainlink team. And we've been working very closely with them for the last, 4 or 5 months to tailor a solution that, their protocol can support, but also meets the needs that we have in terms of, throughput and availability and, range of assets, et cetera. And, it's been a really great collaboration, working with them. They've got some awesome engineers, and I think that when that launches on mainnet, hopefully towards the end of this year, it will be probably the best combination of trade-offs that we could have right now. Obviously in the future, there's going to be other solutions out there, and we'll explore those. But I think in the short term, that will be more than sufficient for our current needs.
No, that's huge, and congrats on exploring that with Chainlink. I'm definitely excited to follow and see what turns out from that. And Kain, you're very upfront about issues you guys faced, and I think that's admirable. I mean, when you guys faced the price oracle exploit, back in the summer, I mean, how did you guys go about handling that? Because it seems like some of these exploits are make or break for projects, but it seems like you guys have not only grown to overcome this, but are now looking at pretty solid alternatives here.
Yeah, thank you. I mean, I guess I've been running startups for a long time, and startups are just really lurching from crisis to crisis, right? And so, I've dealt with very high severity outages in a bunch of different projects over the last 20 years. I think crypto is the stakes are even higher, and the risks are even higher because unlike a centralized system where you might be able to roll some stuff back, and it's unlikely that people will be able to kind of make off with significant value. The outages typically tend to be more customer impacting in terms of lack of availability of a service for a few days while you're trying to figure something out. But in crypto, funds are at risk, and they can disappear really quickly. So, like any crisis, you need to, I think, be as transparent as you possibly can. I think the biggest mistake when there's something going on that people are worried about not understanding what's happening. They're worried about not having information. And in our case, we sort of trusted our community that they understood these risks. And the vast majority of the people that were highly engaged understood that something like this could happen. And so trying to pretend like it wasn't happening was not a viable approach to the problem. We needed to be as transparent as possible. And we said, look, this risk that was a hypothetical is now a very practical risk that we're dealing with, and we're working on a solution. And we were luckily able to kind of come up to a resolution that didn't require forking the protocol and redeploying everything, which would have been, I guess, the worst case scenario. But there's still a number of risks in the system that we're working on mitigating that are sort of in the system today. So it's not like we've resolved all these issues. Even once we get Chainlink deployed, that will take a significant amount of Oracle risk out of the system. But there's other risks around centralization and some other aspects of the system as well. So.
No, for sure. And transparency from you guys and the team is huge, and that's awesome. And, Kain, just to kind of tie this around for the listener, I know it might be hard to do on a podcast forum, but, people could, hopefully follow along a little bit online. Could you just walk us through like a very quick example of how people would use their ETH, use the Mintr, use the exchange, just to get involved in the platform? I just want to make sure everybody could, mentally tie the loop here on how Synthetix works and how the actual platform works.
Yeah, for sure. Look, to be totally honest with you, I'm like the absolute worst person to walk people through a simple explanation. I tend to get bogged down in detail, but I'll do my best. So I think there's kind of two categories of usage that we have. One is you hear about the project and you hear about an asset that you might want to get exposure to. Let's take the centralized exchange token basket. So that basket is made up of centralized exchange tokens like Binance, Huobi, etc. So, you're listening to the podcast, you've heard about it, and you're like, that sounds like a cool thing that I want exposure to. I'm bullish on, or maybe bearish if you want the short version of that token on this category of assets. And I don't want to have to go to 5 different exchanges, have 3 different types of wallets, have them sitting on exchanges, et cetera. I just want a single token that gives me exposure to this asset. The best way to do that is to take ETH that you've got and convert it into synthetic ETH via Uniswap. So, if you've used Uniswap before, you can essentially just turn up and select synthetic ETH as the option that you want to convert your ETH into. Once you've got synthetic ETH, you can then go to Synthetix Exchange and you can convert that synthetic ETH into the centralized exchange token. And the centralized exchange token is SCEX is the ticker. And basically what that will give you price exposure to is this aggregate basket of centralized exchange tokens. And you can hold it for a day, a week, a month, or whatever. And then you can convert that back into ETH via the Synthetix Exchange platform. You can turn up with that token and convert it back into synthetic ETH, and then convert the synthetic ETH back into ETH. Hopefully with a profit. In Uniswap. So that's kind of the trading use case of someone who wants exposure to something like gold or Bitcoin or centralized exchanges on Ethereum. That's the trading experience that we have. And then there's obviously the other experience, which is staking the system and participating in collateralizing it.
No, that's a great run through. And Kain, just one more high level question before we switch over to stuff, a little more technical stuff. it seems like if I have ETH, I can use your platform to get exposure to, a wide range of assets synthetically, without ever leaving my browser, without ever opening a bank account, without ever doing any KYC, AML, stuff like that. Not that I'm telling people to avoid that, but can you kind of walk us through what are the alternatives to get exposure to these assets today? And, even can you? Because it seems like you guys are the only game in town, and I'm hoping people understand how easy it is to kind of use your platform to get that synthetic exposure.
Yeah, so I think at the moment we don't have anything other than probably that centralized exchange token that's really differentiated. Next week or pretty soon, like in the next kind of 10 days, we're going to be launching a DeFi token as well. So we actually had a voting period where a bunch of different protocol tokens for different DeFi projects were paired off against each other, and so that DeFi index will track Link, 0x, Maker, etc., and allow people to kind of have exposure to a basket of these tokens. And again, those are, I guess, some of the differentiated products, but probably the biggest advantage is in that you can get access to all of them in one platform. And so let's say you turn up and you convert $1,000 worth of ETH into synthetic gold or synthetic Bitcoin. You can then go back to the platform the next day and convert that gold or synthetic Bitcoin into, say, synthetic centralized exchange token basket, and hold that basket, or the DeFi index token. And then you can come back the next day and convert it back into synthetic Bitcoin again. So you have the ability on one platform to get exposure to a wide range of assets. And then, at the end of the day, you can come back and convert it into, AUD if you want, synthetic Australian dollars. Not that that's a great investment at the moment, but, you could do it if you wanted to. And again, it's all on one platform, and there's no slippage. So, once you're holding one of these synthetic assets, you have the ability to convert the asset that you're holding, the synthetic debt that you're holding, into any other asset at the spot price, at the current prevailing price, and you just pay 30 to 50 basis points, depending on the current fees. And that's essentially, all encapsulated on one platform. You've got all these different assets, and obviously the asset base is going to grow, over the next 6 to 12 months, and there'll be even more assets. And as you kind of alluded to at the beginning, equities, indices, et cetera. So, you can go from Tesla to gold to Bitcoin all on one platform, at some point in the future, without, leaving the Ethereum ecosystem.
Hey everyone, we'll continue this conversation shortly, but first, a quick word from our amazing sponsors. Are you interested in getting into the cryptocurrency markets but don't know where to start building your portfolio? We have the answer for you. It's called CopyTrader by eToro. With CopyTrader, you can automatically copy every trade of eToro's top crypto traders at the exact price in real time. No need to study up on markets or develop your own strategies. Simply sign up and copy the trader of your choice. Any profits they make, you do too. With eToro, you get access to the world's most popular cryptocurrencies with transparent trading fees all in one easy-to-use app. Copy the smart money with eToro. Join now at b.tc/eToroReaction, linked in the show notes below. I also want to tell you guys about Celsius Network. They're doing a really cool thing trying to revolutionize the way we think about financial services. Basically, they're offering their users up to 10% annual interest on their crypto deposits, and there's no secret to how they're doing it. That 10% comes from them sharing 80% of their profits, rather than the minimal percent normal bank share. Celsius is giving users $10 in Bitcoin when they make a deposit of $200 or more in crypto or stablecoins when they use the promo code Shane. Celsius is linked in the show notes below. Check them out. And
just to kind of touch on some of those points a little bit more, when you go to Synthetix Exchange, it has that look and feel of trading, but that's not really what's occurring, right? It's really and you mentioned this, a conversion of the debt. Maybe you could just walk us through, maybe more so the mechanics, and also another interesting point you touched on was the idea of no price slippage and infinite liquidity. Those ideas maybe were lost on listeners at first, but if you could kind of dive into how that works and why that's an advantage relative to peers.
Yeah, for sure. So I think, what we've kind of seen over the last year is the peer-to-contract trading, particularly enabled by Uniswap, is a far more kind of elegant and efficient solution to liquidity on decentralized trading platform, right? And I think it wasn't really immediately obvious to everyone why that was the case, but I think the best example is sort of taking 10 different people who don't know each other, who all want to provide liquidity for a specific token, and they all have different amounts of money. Someone might have $100,000, someone has $100, and they can all collectively turn up to this platform called Uniswap, pool their liquidity to act as counterparties to people who want to trade those assets and collect fees from it. And that's just not something that's ever existed before. In the past, when you wanted to trade on a platform or provide liquidity, you needed to be a market maker, you needed to turn up, you needed to have active orders in the book, you needed to be responsive to market conditions, et cetera. You couldn't just turn up and say, I've got these assets and I'm going to provide liquidity, and the platform itself would take care of the market making, essentially. And the experience for the person on the other side of that is they can turn up and they can trade against this pooled collateral, and they have theoretically much better liquidity, much less slippage, much more depth, and it's always on. They don't need to turn up and wait for someone to match their order. They can, the prevailing price is always available to them. And I think that is just a shift in providing liquidity and trading that people are only now just kind of grasping. And Synthetix Exchange works in a very similar way. You have this group of several thousand people that have all some of them know each other, some of them don't. They've all turned up and they have added collateral. They've put capital into this platform called Synthetix to create this pool of liquidity that anyone can turn up and trade against. And so the way that works is they issue debt. So everyone who's collateralizing the system issues debt into the system, and anyone can buy that debt. And once you own that debt, you have a right to reprice that debt by coming to the contract and presenting that debt. So if you're holding debt that's denominated in US dollars and you want to convert that debt into debt that's denominated in Bitcoin, you can do that. And the contracts basically say that you can convert the entire value that you have in debt, in SUSD, so synthetic US dollars, into synthetic Bitcoin at the prevailing spot rate with no slippage. You just pay a single fee. And the way that works is the contract will take your synthetic US dollars, the debt that's there, and it burns it. And it then simultaneously mints new synthetic Bitcoin debt. And when it makes that transaction, it's an atomic transaction that balances the debt. So the value of the debt in US dollars is matched with the value of the debt in Bitcoin. And that's what allows people to kind of turn up to this platform and trade, is that all of the SNX stakers have provided the collateral to be this pooled counterparty to those trades, so that you can turn up and reprice your debt. And as much debt as you have, you can reprice. So we've seen orders as large as $1 million. Or even more in some cases, where someone has $1 million worth of synthetic USD and they convert it into $1 million worth of synthetic Bitcoin.
No, that's a great point. I think that pooled counterparty model that you mentioned is really important for helping the platform differentiate itself. You have some competitors that are doing similar types of work where you have synthetic tokens, but those are structured more similar to a swap, where to get that off the ground, you need a counterparty right away willing to accept the other side of the trade. With Synthetix, you're always facing that pooled counterparty. So that type of perhaps near-term mismatch doesn't happen. It allows there to be a lot more trading from the start. It's kind of reminiscent of how a bank works, right? Where they trade with different funds. Funds rarely trade with each other. There's that bank in the middle. And the bank basically, takes one side of the trade, will take another side of the trade. And that whole time, they're trying to make their book as market neutral as possible. Meanwhile, they're collecting fees, and ultimately, if their book were to blow up, their derivatives book were to blow up, it's the bank equity holders at risk. Very similar 100%. To SNX in this situation. So there's a lot of parallels between what you're building for the future and what already exists in traditional finance. But of course, there are risks with this model as well. Because you're the pooled counterparty, that makes the stakers take the other side of the trade, which, has its benefits, as we just went through, but there are also risks with that, such as a lack of short exposure, could really be a risk if, markets rip higher and Synthetix Exchange is, predominantly long exposure. Maybe if you could walk through how you think about that risk, new ways to kind of maybe make the Synthetix Exchange more market neutral, and then other types of mechanisms that you're thinking long term that can kind of bolster that ability.
Yeah, for sure. So just to, I guess, maybe touch on the differences between this model and some of the other models out there that require kind of matched counterparties. I think they both have a place. There's things like UMA, right? UMA is interesting because the number of exotic assets that you can support is just significantly higher, right? It just means that you need two counterparties, to be willing to kind of trade. So you have that liquidity challenge, right? But if there are two counterparties who are willing to trade some crazy exotic asset, you can have that. Whereas I think with the Synthetix Exchange model, the pooled counterparties, your example of the bank, the equity holders, we've kind of replaced the bank with this distributed group of people that have agreed to come together based on a set of rules that are enforceable on chain, but they do need to agree, on some level to what will be added to this, right? And so, we need to kind of de-risk as much as possible, what assets are listed, and you can't have super liquid assets or things like that are very high risk, because it just requires some kind of risk mitigation. But right now, with the current open interest that we have, it is very long. And I think that it's one of the aspects that we're really working on is getting the platform to a place where more professional traders, market makers, et cetera, see the value in coming in and balancing the open interest. And one of the things we need to do there is we need to have a system where they're actually paid to do that. And so in synthetic positions, which is essentially synthetic futures, which will be launching later this year or early next year, we will have a balancing mechanism where longs pay shorts and vice versa, depending on what the skew is in open interest. And it's mechanisms like that will help to make it more market neutral. But I think it is still possible for the debt to be mainly long biased, and for the collective counterparties, the pooled counterparties, the SNX stakers, to actually hedge outside of the system. So one of the examples we use is, let's say everyone's holding long Bitcoin, right? Because people just want Bitcoin exposure. There's a lot of long Bitcoin open interest on Ethereum, and the SNX stakers want to hedge that. It's very possible for them to take the proceeds from the debt that they sold to these people who want long exposure on Ethereum and hedge it by holding BTC, either futures or options, or even on the spot market, as a hedge against that. And then they remain market neutral outside of the system, such that even if the Bitcoin does run up significantly, they've hedged their exposure outside the system and will be able to cover that debt increase internal to the system through the external hedging that they've taken. So there's a number of different things. We don't have to have a perfectly market neutral mechanism for the system to be viable. It's also possible for people to be hedging outside. And, interestingly, you create a market for hedging, because the more effective and efficient you are at hedging your exposure, both internally and externally to the system, the more profit you're going to make. And so you've created this marketplace where it's not just everyone turns up and, holds hands and sings Kumbaya. There is a level of competition for people who are participating in this network to try and, outcompete the others in the network to generate significant profit. So, there's a number of kind of layers to this mechanism that, again, will kind of evolve over the next 6 to 12 to 18 to 24 months. But, it's a process that we need to kind of educate people on, and an opportunity that we need to, make clear is there. for professional traders and market makers.
Absolutely, and to your point, just being long biased doesn't make it non-viable. Right now, you could have a market dip where the SNX stakers actually earn more because of it, because they're taking that other side of the trade. So it's very it's based on a lot of variables, and it's more complex than just saying, oh, it's long bias, this is a risk. It's more nuanced than that, for sure.
Yeah.
And Kain, just switching gears a little bit, you guys are based, you're built on Ethereum, so you guys have the normal kind of concerns on scalability there. Optimistic rollups are coming around. There's a lot of layer 2s rolling around. ETH 2.0 with sharding is on the horizon, months or years out, depending on what phase you're looking at. How are you guys attacking scale, or how are you addressing it? Because it seems like you need scale for to Synthetix to operate at scale, but also to keep fees low.
Yeah, so we've done a lot of R&D this year into L2. Obviously optimistic rollups have just kind of burst onto the scene again, or rollups in general have kind of burst onto the scene again, and there's a lot of interest in that, particularly with the Uniswap implementation from DevCon. So we're looking at a number of different options, but I think one of the advantages that we have is, people talked about this a lot in the kind of early Ethereum days, that, it may not be micropayments. It just isn't going to be micropayments, right, that Ethereum works for, but it may be, large transactions, large, settlements that in the short to medium term are where most of the activity happens. And I think that's a big reason why DeFi has worked so well, because, it's not gaming. It doesn't need ultra high throughput. You're not doing high frequency trading. You're doing, large block trades. And so what we've actually seen is that, our platform can handle very, very large volumes, because the average trade size is so high, because you don't have this slippage issue. And so, we'll see days where the average trade size is $50,000 to $100,000, which is obviously far, far higher than the average, DEX. And it's kind of, one of the advantages that I think that we have in the short term over, other platforms where it's counterparty matching. So, we think that the platform, even now, even on ETH, 1.0, before any kind of scaling has been applied, L2 or anything like that, we can easily handle tens of millions of volume a day. And I think, a couple of days ago, we did $27 million a day, in a day, sorry. So, it wouldn't surprise me if in the next, couple of months, we have a few days where over $100 million is traded. And that's very supportable on the current Ethereum, architecture.
Yeah, that's great. And I think, while we're on the topic of just, exchange volume, maybe you could talk about, the growth you've seen year to date in volume, and also, user growth as well. Are you seeing more traders than you were a few months ago? How is that, demographic playing out? Do you believe they're mostly traders and stakers, or do you think there's an independent group of traders starting to, explore Synthetix and use the platform?
Yeah, so I think there's a number of things to kind of unpack in that question. One of the main drivers at the moment of volume is people attempting to front run. So bots that are attempting to exploit latency in the oracles and the mechanism itself. And we've spent a lot of time this year, a lot more than we were kind of hoping to or expected to, in trying to mitigate those exploits. We will, by the end of the year, have a queuing mechanism, which we think will, essentially remove all of the front-running attacks. But crypto is adversarial, and there's always new exploits and new approaches that people are trying to come up with. And so a lot of the volume is being driven by that. And then you've got this secondary sort of more organic volume, I guess, and that is mainly been driven by stakers who have minted, they've got debt, they're trading on the platform actively. But it's funny, you talked about the market can kind of move against you in the other direction if everyone's long. Go back to July when ETH was sitting above 300, and basically everyone who was minting was sitting long in ETH. And so there were a lot of people who were trading at the time. And a lot of people who were long ETH, and when the correction came and ETH dropped back down to 150, trading actually significantly dried up. And we kind of anecdotally That even includes me. I was pretty long ETH, and I got kind of trapped in a couple of positions where I was like, okay, I'll just ride it out. And so I was trading much less actively because all my positions were just underwater, essentially. And as ETH has kind of recovered, and as SNX has grown over the last couple of months, there's been more synth supply out there, and we've seen that organic volume coming from stakers grow, back to kind of where it was, $2 or $3 million a day, et cetera. But obviously the main aim is to bring non-stakers into the system and get them trading. But to be perfectly frank, the system is just not really ready for us to kind of push it as a trading platform. I think one of the worst possible things you can do when you're building a product is bring people into a porous funnel. And right now the user experience on Synthetix Exchange is just not acceptable. We've focused a lot on the architecture of the platform and far less on the product. And so the next kind of 6 months is going to be a big refocus on actually getting the platform up to where it needs to be, so that someone who is seeing it for the first time, it's comprehensible to them, and is I guess aligned with other trading platforms that they're used to using, and is usable and all of the things we need it to be. And I think once we've gotten to that point and we're comfortable that the product itself is polished enough to bring external people in, then we'll start to really look to kind of ramp up the awareness building for traders and try and compete with other trading platforms out there, other derivatives and futures platforms.
Yeah, I think that type of self-awareness where you're acknowledging that the platform's not there yet, and really right now is just more of like a test phase, right? Where you're getting live data from the market, you're seeing how people are interacting with the platform. To your point, just using the front running example, you didn't imagine you'd spend so much time on that. So these types of issues are good to get out of the way early before you do have that influx of traders. So I think you're taking the right approach there, for sure.
And Kain, just to absolutely. And Kain, just to kind of close out here, kind of like a two-pronged question. I mean, how important is composability for Synthetix, and are you seeing that out in the wild? And I guess my second question, it might not be applicable, but I mean, the goal of composability is to build, very user-friendly, agile applications here that anybody can really use. Do you think that if composability takes off here, or, further takes off, that you guys can attract, much larger users to the platform, say major institutions or traditional banks?
Yeah, I mean, absolutely. I think composability is critical for the platform to work, and it can't just all be activity that's happening on Synthetix Exchange. Synthetix Exchange will be a venue for trading that kind of targets sophisticated users. But even in the last couple of weeks, so we've been participating in a lot more hackathons. So there was a Kyber hackathon, Chainlink hackathon, and a couple of online hackathons that have kind of wrapped up recently. And some of the projects that people have built, allowing people to earn interest and convert that interest into kind of recipes, some of which use Synthetix. So, the guys from Dex Wallet built something that allows you to hold different synths to get exposure to gold, Bitcoin, to have recipes like an ETH maximalist recipe, which is long ETH and short BTC. So there's some really cool stuff that's just starting to pop up. We're getting more integrations into things like 1-inch exchange. There's people looking at building atomic swaps into Uniswap and Kyber, some of the other dexes, so that the example that I gave previously of, you hear about this centralized exchange token and you think it's cool and you want to play around with it, you need to learn Synthetix Exchange to be able to do that. Ideally, what we want is a scenario where someone can just turn off the Uniswap or Kyber that they already know and take their ETH and select centralized exchange token, and with one click they've got that token. And then, to wind back that trade in the same way, a few weeks later, they can go on Kyber or Uniswap and sell down the centralized exchange token back into ETH, or to DAI, or to whatever. So, we're just now starting to see these sorts of things pop up. And it's probably the most excited that I've been, about the kind of, prospects of the project, when we're seeing engineers actually, take time to build and understand and integrate the project and integrate Synths into their platforms. There's probably no better validation of what we've been working on over the last couple of years than that. So it's super exciting, and I think it's critical.
Yeah, and going off that point as well, one thing that I think was discussed on the governance call was just the idea of in the future implementing a way for people that are currently holding ETH to just kind of visit the exchange, and as soon as they interact with it and deposit it, they're kind of credited synthetic ETH on that side, so they can immediately start trading. Maybe you could touch on the benefits you think of that, the benefits you see in that, and how it could help spur a better user experience, but also greater adoption.
Yeah, I mean, you just want to make it as low friction as possible for users, right? It is something that I think doesn't get as much focus in the space, and that's for kind of architectural reasons. I think we're all so focused on building out the architecture and getting things actually functional that often, with some exceptions like Dharma, the actual user experience is an afterthought, and we've certainly been guilty of that in the past. So I think you have to take a holistic approach. You have to build the accessibility and build a frictionless experience at the architectural level, all the way through to the actual DApp interfaces. We've done a bad job of having mobile interfaces available. So there's a whole bunch of things that we need to do to kind of get this product up to a point where it is usable and that it's as frictionless as possible. And I think that again is something that kind of excites me, is that we've done almost none of that, and we've still got the level of kind of interest that we've had. So it really speaks to the potential growth if we can get some of those things right over the next 6 to 12 months.
Yeah, Kain, that's huge. I'm all about that. Success isn't binary, but you're kind of proving it as you go. And one of our last questions on that point is, I think you guys are set to launch kind of a new UX for the exchange and the Mintr section. Could you talk a little bit about what you expect there and when you guys expect those to launch?
Yeah, so we've gathered a lot of data from Mintr over the last 18 months or so, and I think that we've got in beta now. There is a beta version of Mintr. It's not quite ready for prime time yet, but it's getting close. And what we've really sort of tried to kind of take away from the feedback we've had from users is, you build something and then you see how people actually use it. And oftentimes they use it in a way that's different to what we're expecting or, what you anticipated. And so we've built a lot of functionality in to just make the operations that people are doing day to day much easier, and to provide much clearer information about what's happening. So, probably the best example is a lot of people struggle to understand how they can transfer SNX given that they've got debt. So they've staked the system and then they've got some debt and they want to be able to move some of their SNX and they want to, partially exit. And we didn't really do a good job of kind of explaining that and walking that through. And that was a big point of friction for most users. And so in Mintr v2, in the beta, it's much clearer about, what's locked, how to unlock it, what you need to burn, how much debt you have, et cetera, and much more clearly kind of explained. So things like that are, we're obviously working on. And then Synthetix Exchange v2 will be almost a complete, from the ground up rebuild. And the intent is to get it much closer to, what you see in other trading platforms, centralized exchange platforms, et cetera. So, something more like a Kraken or Coinbase or Binance experience that people are used to, so that, people don't need to relearn or, learn new patterns. They can just, kind of go and do what they're expecting to do from their, past experience with other trading platforms.
Okay, and that's huge. And I really appreciate you coming on and giving us this deep dive because, it seems technical at first, but once it clicks, and you guys are a super interesting project. Complete disclosure is that we own SNX tokens. It's in the show notes below for our complete disclosures, just so everyone's aware of that. I also want to thank my partner, Medio, for coming on and co-hosting this, given his research on your platform. And Kain, where can people learn more about you and learn more about Synthetix?
I think, we're pretty active. I'm pretty active on Twitter, but definitely our Discord channel. is the best place to kind of come in. Everyone's fairly friendly for a crypto community. And so, if you come in and ask dumb questions, people will be happy to handhold and walk you through the platform. So, that's a great place to jump in and kind of, get your feet wet.
That's awesome. Yeah, we'll link those in the show notes below. But Kain, thanks so much for coming on, and Medio, thanks again as well.
Thank you.
Thanks, guys. Really appreciate that. It was great fun.
Hey, everyone. Thanks for listening to the episode. If you can go to iTunes and hit subscribe to the Chain Reaction podcast, it'll go a long way in helping us reach new listeners and help support the show. Thanks again.